My name is Siriana Rivera, and in this video, I'm gonna walk you through how I did my accounting project for Northland Physical Therapy. I'll just be explaining step by step how I did everything. So the first thing I did was record the journal entries for all the transactions during the year and see which accounts were affected and how they were affected, like if they went up or down and if they were debited or credited. For example, in the transaction A, it says the company borrowed $31 cash and signed a 6-month note payable. So since they borrowed cash, that means cash went up by 31, and since they have a notes payable on that, notes payable also went up by 31. Then another example would be transaction B. It says they purchased equipment for $34 cash. So since they got new equipment, that made equipment go 34, and since they bought the equipment with cash, it made the cash go down by 34. And whenever assets go up, they're debited, and whenever they go down, they're credited. So that's why since equipment went up, it was debited, and since cash went down, it was credited. And I just did everything the same step for the rest of the transactions. After the journal entries, I made the unadjusted trial balance, and this is basically a list of all the accounts and their balances before any adjustments. All of the balances came from the beginning balance of the accounts and the changes made with the transactions. Here the debits and the credits should equal each other, and as we can see, they did. But also at this stage, some things like unpaid expenses or used supplies still need to be adjusted. Next, I did the adjusting journal entries at the end of the year, December 31st. These adjustments, they make sure everything is reported in the right period. And as we can see, here I recorded amortization for 3,000. And then on this one, L, it says supplies. Okay, I'm sorry about that. It says in the letter L, it says only 3,000 were counted for supplies. So what I did was record it as record the rest as supplies expense. I also added depreciation for equipment. Then on letter N, there was interest on the note that had not been paid yet, so I recorded that as interest payable right here. And I also added salaries that were earned but not paid, and finally recorded income tax expense of 4,000 that would be paid next year. And then after all the adjustments, all accounts should reflect the true financial position of the company at the end of the year. After the adjustments from the journal entries, I made the adjusted trial balance, as we can see. And this is what I use to make all the financial statements that will come after this. And basically, it includes every updated account. So now it's like an accurate picture of how the business really did for the year. Here I have the income statement, which has revenues, expenses, and then it'll give you your net income or the company's net income. So first I put the revenues, and the total revenues were 64. Over here we have the service revenue, and that's it for this company. So total revenues is 64,000. And then after revenues, I put expenses. Expenses include salaries and wages expense, supplies expense, depreciation expense, amortization expense, interest expense, and income tax expense. So we add all this up, and our total expenses would be 61,000. And the way we get our net income is we take our total expenses and subtract them to the total of revenues, which would equal 3,000. After the net income, I made the statement of retained earnings. I started with the beginning balance of the year, which was 5,000, and then I added the net income, which was 3,000, and here you would subtract any dividends, but as we can see, we didn't have any, so I added up the beginning balance and the net income, 5 plus 3, and I got 8,000 for the ending balance at the end of the year, December 31st. And this statement, it shows how much the company's profit was kept in the business instead of being paid out. Next, I did the balance sheet, which lists all of the company's assets, liabilities, and stockholders' equity at the end of the year. First, I put the assets and the current assets, which were cash, accounts receivable, and supplies, and then added them up and got the total for current assets, which was 30,000. And then after current assets, we put long-term assets, which would include equipment, accumulated depreciation, software, and accumulated amortization. Which these two, the accumulated ones, we would subtract. And then we add all the assets up and get 71,000 for the total assets. And then on this side, we have the liabilities, and it's like the same thing as the assets. We have current liabilities. So I added them up and got 43,000 for total current liabilities. And then we have stockholders equity, which include common stock and retained earnings. Added them up and got 28,000. And then we have to add 43,000 and 28 to get total liabilities and stockholders equity. And this statement shows us what the business owns, what it owes, and how much it belongs to the owners. Or how much belongs to the owners. After I did the financial statements, I did the closing journal entries, and these are used to set temporary accounts like revenues, expenses, and dividends back to zero. So it's like starting off fresh the next new year. But the retained earnings account still has the results from this year. Here I have all the T accounts, which gives us a visual of all the activities in each account. You can see the debits and credits to make sure all transactions were recorded correctly. Then here I made the post-closing trial balance, which includes only the permanent accounts because I already closed the temporary ones before this. And permanent accounts include things like assets, liabilities, and equity. And this would be the last step before starting the new year's accounting period. Then I had to find out how much net income the company generated during 2024 and what was their net profit margin. So to find this, I started with the company's revenues from the adjusted trial balance. Then I subtracted all of the expenses like salaries and wages expense, supplies expense, all the expenses. And then after subtracting all of those, the business ended up with a net income of 3,000 for the year. So basically, total revenues minus total expenses equals net income. And then once I had the net income, I used that number to calculate the net profit margin. And the formula I use for the net profit margin is net profit margin equals net income divided by total revenue multiplied by 100. So I took the 3,000 net income and divided it by the total revenue amount, which gave me 4.7%. And this means that for every dollar the company earned in revenue, it kept about 4.7 cents as profit after covering all costs and expenses. And this tells us like the business is making a small profit, which is good, but there's still room to improve the company's overall efficiency and profit margin. Next, I have this question asking if the business was financed primarily by liabilities or stockholders' equity. And I said it's financed primarily by liabilities based on the balance sheet. And this means that the company depends more on borrowed funds than on things they actually own, which means they have debt they gotta pay off. And lastly, I had to find out the company's current ratio, which shows how easily a company can pay its short term debts with short term assets. The way I found the ratio is I divided the current assets which were 30,000 by current liabilities which were 43,000, and that gave me a ratio of 0.70. And this means that for every dollar the company owes within a year, it only has 70 cents in current assets available. And the ratio below 1 shows that the company might have trouble covering its short term obligations. And this is all for the project. Thank you for watching.